Time frame correlation involves finding potential trading opportunities on the higher time frames, but actually executing the trade off of a lower time frame. An example of this would be finding a daily trade idea on a daily chart, but executing on instead a 4-hourly chart or an hourly chart. The idea with time frame correlation is to get a smaller stop loss on the trade. Therefore, you will slightly reduce the success rate. However, the reward to risk on the trade can be doubled if not tripled, depending on the time frame that you actually execute the trade on. If you bear in mind a typical daily chart is typically each bar around 100 to 150 pips, whereas a 4-hourly chart may have bars around 50-60 pips and an hourly chart around 20 to 25 pips, you can see that having a trade on an hourly or a 4-hourly chart is going to give you a much smaller stop loss. And of course, if you can allow the trade to run on the higher time frame, then the reward to risk on the trade will be significantly greater. We're now on the New Zealand dollar on the daily chart, and we're going to highlight some of the support and resistance levels on this chart first of all, and then zoom in and have a look at what potential trading opportunities there were using things like price action, divergences and cyclicity. If we start off to begin with, marking on the horizontal levels, we'll put the extreme lows in down there and the highs up here. Now there's an awful lot of price action data to look at through here, but let's go through and just plot the key levels. We have this resistance level here becoming support. We have a strong support level through here that gets retested. We can also make a note of this resistance becoming support, getting retested over here again as well. And as we progress through from here, we can also make a note of the resistance levels that hold around this kind of an area. Now that we've managed to plot these support and resistance levels, bearing in mind that we've got the extreme lows and extreme highs over the last year here, we're going to zoom in and look at what potential trading opportunities there could have been. The first area we're going to focus on is highlighted in yellow now, where this resistance became support. The reason we're going to do this is because first of all we had the double bottom formation in the W shape, which then came back and retested and shot off to the upside. Now you may not have known that there was going to be a potential trading opportunity at this double bottom, but certainly the retest itself may have presented an opportunity. Bearing in mind we're currently looking on the daily chart, before we can even think about going any lower than hourly charts, we need to go down one time frame at a time. So if we're currently on the daily chart, we're going to move down to the 4-hourly chart and see what happened in that kind of an area. So now that we've gone to the 4-hourly time frame, we can see the daily levels are still marked here. We're going to zoom into that key area, which is highlighted in yellow. Now the interesting part here is that we have actually got several different reasons to want to take this trade to the upside. First of all, we have this trading range on the 4-hourly chart, which we can see has been broken through, retested, test, and created this trading range. But price deliberately and distinctly broke through that level and pulled back down again to this resistance becoming support, which of course is the big long-term W shape that we saw on the daily chart. If we look at the price action for a start, we can see that we had bearish candles on the way down in black, or if you prefer your bars, we can see the seller bars on the way down through here. The interesting part here is we can actually see two bullish pin bars. We can see, if I move this line very slightly, how we have the open and the close in the upper 50%, and again on this one as well. So price action certainly supports that shift to the upside. but also we have the shift from sellers to buyers. Just looking at the reversal bar formation, we have 5 bearish candles or 5 seller bars that shift across to a bullish candle or a buyer bar. So we have that shift in sentiment there looking at the price action. It's also worthwhile pointing out that we have a higher low, and a higher high. So we have the higher low, the higher high, and the higher low. So certainly on this 4-hourly chart, we are actually in uptrend. Whether the daily chart were in downtrend or not, we actually have ourselves a 4-hourly upward trend here. Now, of course, we always go with the context of the higher time frame, and it's the daily chart that gave us the signal. Bearing in mind the trend on the New Zealand dollar over this period was to the downside. However, it's the double bottom formation with the break and the retest that gave us the signal. It's that first higher low, that first break in cyclicity that we can see on this daily chart. In fact, we can even see the higher high on the daily chart after the double bottom. And on the 4-hourly chart, of course, it's going to already be in an upward trend at that point in time. So having seen that, we've got the cyclicity on our side, the price action on our side, and also we happen to have a divergence on our side as well. We see the higher low over this period on the price action, whereas the stochastic actually has a lower low, giving us continuation divergence, telling us price is likely to move to the upside. If we look at where this continuation divergence actually flicks up, and we'll zoom in here to get greater clarity, we can see it actually flicks up here. So provided that we now shrink this back down again, we can see that our actual buy signal comes on this bullish candle, which happens to be that shift from sellers into buyers. And of course, it's actually also a bearish pin bar. Now the interesting part here is that if people have been selling through this area, it's likely that they'll have their stop losses behind this bearish pin bar. Therefore, the way that we would look to trade this, we'll highlight the entry in blue, is to enter a few pips above the high of that bullish candle, which is the bearish pin bar. So people that have been short through here are likely to get stopped out behind that level for a small profit or potentially a loss, but certainly we're looking to get long, and where other people are getting stopped out, it's a good time for us to get into the market. The reason for this is because price will tend to move aggressively in our direction. And you can see straight away after that, we can see the aggressive move to the upside. So it's likely that some of the people that were short through here actually made some money, but certainly as they got stopped out with a small win, we then got triggered into our trade to the upside. Our stop loss on that trade, well, we could have had a stop loss in a really safe position underneath this absolute swing low, which is a daily chart swing low. But the fact is there's no point doing that. There's no point drilling down to get the 4-hour entry if we're going to go and put a daily stop loss on it. If we're going to enter on the 4-hourly chart, we have to then put our stop loss, which I'll indicate in red, we have to put our stop loss underneath this new support level, underneath the 4-hourly chart price action. Now what that means for us is that we actually end up with a stop loss that is around about 38 pips, add a few extra either side, let's call it 45 pips. But a 45 pip stop loss is quite a small stop loss. If we jump up to the daily chart, trading the same thing on the daily chart would have led to us having over a 100-point stop loss. So there you can see the difference straight away. A 100-point stop loss or a 45-point stop loss. That's a very big difference considering the fact that the price then pretty aggressively moved 250 pips to the upside before it showed any signs of slowing down. Certainly there are a good 200 pips in this move before there's any real cause for concern. And then we can see that actually the daily chart gave us the trading idea or the trading opportunity. It gave us the direction we wanted to trade because of the double bottom, and also interestingly enough, there was a reversal divergence here on the daily chart as well. We also saw the price action pattern, we saw the resistance become support, we saw the retest, and the time frame correlation aspect there was actually finding an entry on the 4-hourly time frame rather than finding the entry on the daily chart. Now, time frame correlation, in order to keep a relatively good success rate, makes sense to be just one time frame apart. That means if you have a daily trading idea, perhaps trading on a 4-hourly chart. The further apart the time frames are, the lower your success rate will be, but the higher your reward to risk. Bear in mind that reward to risk will typically lead to good profits if the reward to risk is increased, but at the same time we must also have a decent enough success rate for us to psychologically be able to keep trading. If we take this highlighted area and go down to an hourly chart, just to see what actually was there, we see perhaps there was an hourly entry opportunity. We see the divergence here, the reversal divergence, give us the first signal on this bullish pin bar, which I'll highlight with an arrow. If we had chosen to go down to this smaller time frame, this hourly chart, we could have reduced the stop loss even further down to about a 25-point stop loss. The fact is, it's more than likely that you probably didn't do this. In fact, just one time frame apart from the daily down to the 4-hourly is enough for most people to do. As you grow with your experience as a trader and you progress as a trader, it is possible to go down to the hourly charts for these entries, but certainly it makes no sense to go any lower than that. The hourly chart is pretty much the lowest time frame that you can go to, with a price action still making sense and logical. If you go down any lower than the hourly chart to 15-minute charts or even lower, the price action gets exceptionally messy. Of course, looking back, you'll always find a reason to enter into the marketplace. The fact is, at the time on the 15-minute chart, there was probably nothing there. So there we have it. As an overview of time frame correlation, you want to make sure that you have your daily context first of all, and then go down a time frame and see if you can find a good trading opportunity that makes good trading sense. Look for supporting factors like divergence, price action, cyclicity, and build a case for taking the trade. But ask yourself, is it worthwhile going down to the smaller time frame? Or is it a safer bet to stay on the higher time frame? If I were trading this myself at the time, I would have seen the daily chart potential. I would have seen the 4-hourly chart here as well, but it's unlikely that I'd have gone down to the hourly chart on this. Quite simply, I would probably have just been a little bit sneaky with this example. And because the actual bearish pin bar here, the bullish candle, because it had closed at this level, but broken the high of the previous candle, I would have actually been a bit cheeky here and placed my order there. Because I realised that this bullish pin bar, which itself is a buying signal, has already been triggered and is likely to give some movement to the upside. Plus the fact that I see obviously we've got a shift from sellers to buyers, and I am bearing in mind I'm expecting price to go up because I've deliberately targeted this from the higher time frame. That's the way that I would have traded this, with around about a 30 to 35 pip stop loss. But I would not have traded it going down to the hourly chart, because I think the 4-hourly chart presents a really clear picture there. If I've got a really clear picture on a time frame, the trade stands out, I'll simply take it. I may have looked down at the hourly chart, but you can see here on the hourly chart, looking back, we can see the bullish pin bars, but the fact is the market did move sideways for some time going into that. Whereas the 4-hourly chart actually had the higher lows, the higher highs, and was a cleaner trading opportunity. Now that we've seen that specific one there, let's move through and look at some of these additional trading opportunities on this New Zealand dollar currency pair. We're looking now at a trend continuation potential setup, because we can see this support gets retested over here as support again. We just highlight that area. It's also worthwhile noting that in this upward trend that we have that's developed over this period of time, we're in a trading range of sorts, and we're at the lower part of the range. And we also have price action that is oversold in an upward trend. Of course, overbought and oversold does not normally mean a huge amount to us. It's just an interesting factor that could play part of this trade. As we're looking at this on the daily chart itself gave a more than good enough example of sellers becoming buyers at a support level, and there would be nothing wrong with taking this trade at that level itself. The only reason we would perhaps drill down is because we've already seen the support level and we're preempting a move off the level. In order to do that, we jump down to the smaller time frame. So we're going one time frame smaller down to that 4-hourly chart. And I'm going to scrunch the screen up slightly. We can see this support getting tested again and again and again. And then when we move over to see that now on this 4-hourly chart, if we look at the price action itself, first of all we can see that we've had these bearish candles, or these seller bars, that have shifted across from being sellers into buyers. We can see the bearish candles becoming bullish candles. So we can see straight away on this smaller time frame, it does make sense to want to enter into this trade based off of a price action signal. But again, we also want to have multiple things adding to this trade idea. The daily chart gave us the support level, and we've also seen the price action on the 4-hourly chart give a potential reversal there in the price action itself. Bearing in mind on this daily chart, the market's overall moving to the upside, but is in a trading range at present. On the 4-hourly chart, as we look at it, the market is actually moving down into the level. So this is actually a reversal trade off of a support level. And through a reversal trade, it's nice to see that we have this reversal divergence on the stochastic. And the interesting part is we can see we have the higher low on the stochastic, the lower low on the price action, and when the stochastic blue line, which is the %K line, flicks to the upside, we can see that coincides with this price action shift in sentiment from sellers to buyers. If anything, it kind of confirms that the move is likely to take place. And we can point our arrow there to the upside, because that is where we would look to enter this trade on this chart. Now, with regards to how we then manage the trade, it's your choice as to how you choose to go about it, but bearing in mind the reason for this trade was off the daily chart, which means we're expecting price to move to the upside. Similarly, our idea on the previous trade was off the daily chart, so it makes sense to actually trail our stop losses on the higher time frame. It gives our trades a bit more room to breathe. If we look at the most recent example that we're working through, we can see that having entered into the trade, let's just use, for example, the 3-bar trading stop loss method, we can see that originally our entry point would have been around this price action reversal. So I've just marked in the stop loss, which we can see there, and our entry would be just above the high of the candle here. We'll just change that to blue so that we can see that's an entry signal. But all of a sudden now we've managed to get into this trading opportunity with a stop loss of around about 35 pips. Now a 35 pip stop loss, again just like the previous example, gives us a nice tight stop for a very healthy reward to risk trade to the upside. If we look at the daily chart again there, we can see where we have our potential trade ideas. We can just see the blue and the red dots there, which is where our entry was. If we have waited to trade this on the daily chart, rather than having a 35 pip stop, we'd have ended up with a 115, probably 120 pip stop more realistically. So there you have it. There's a big difference between a 35 pip stop loss and 120, 125 pip stop loss. It's almost 100 pips difference in the size of the stop. Of course, the success rate on these trades, these time frame correlated trades, is not quite as high, but you can see for yourselves that the reward to risk on the trades more than happily makes up for it. If we look at the stop loss movement for both these trades now on the daily chart, we'll just make our stop loss line in red. We can see where we'd have originally traded from, and we can see using the lowest low of the last 3 bars, the stop loss would have been moved up and up and up and up and up until around about this level here. Similarly, we can take exactly the same away from this one, the lowest low of the last 3 days, or the last 3 bars. We can see how the stop loss is allowed to breathe and move, whereas perhaps trading our stop loss on the 4-hourly chart may have stopped us out sooner. If we look now at the daily chart trades, the daily chart trades are risking around 100 pips here to make 270. So roughly speaking, a 2.7 to 1 reward to risk. $2.7 to 1 reward to risk. And over here, with 125 pip stop loss and 195 point return, realistically this is about a 1.5 to 1 reward to risk. That means that we risked 1%, made 1.5 times back what we risked, and on this one we made 2.7 times back what we risked. Both of those trades being good, solid reward to risk trades. But now that we start to look at the time frame correlation aspect, let's just drill down to that 4-hourly chart again. And let us remember that we were entering with anything from a 35 pip stop to a 45 pip stop, looking to return from there around 350 pips. Or a 35 pip stop targeting 350 pips puts us in the territory of 10 to 1. That's 10 times our risk has been returned to us. And we can see straight away that is a huge difference compared to the 2.7 to 1. Similarly, if we look at our second example, we know that it was a 1.5 to 1 when it traded on daily charts. Looking at it here now with a 35 pip stop loss and returning 270 pips, again we can see there now a very healthy reward to risk. It's interesting to note that that's actually around about a 7.5 to 1 reward to risk. So suddenly we've turned trades that were 1.5 to 1 and 2.7 to 1. Suddenly now we're looking at 10 to 1 and 7.5 to 1. Rather than just trading on the daily chart and having a 4.2% total return, trading it with the time frame correlated approach put it near a 17.5% return from the 2 trades. That's a huge, huge difference. Of course, nobody's going to be upset with just taking the daily chart trades, but you can see how in time with practice, these higher reward to risk opportunities with time frame correlation give us incredible reward to risk. Notice that we're having to find our daily chart reasons for entry and then actually executing on the lower time frame. We'll look at one more example here. We can see this resistance level, resistance becoming support, and becoming support again through here. And if we just make a note of that and mark it, we can see price action wise, again on the daily chart, we had this shift from sellers into buyers. We had a potential trading opportunity on the daily chart, and we had a bullish pin bar there, which quite happily ran to the upside. Let's take that now and actually drill down to a smaller time frame and see if there was actually a better, smaller stop loss trade entry. And here we have it. So now that we're looking at this smaller 4-hourly chart, let's look at the price action first of all. What we can see, looking at the price action, price cycled into this level and gives a huge, great big bullish pin bar there. And actually, interestingly enough again as well, gives us a shift from sellers to buyers. We can see these bearish candles becoming a bullish candle. And again, surprisingly enough, we see a divergence there off of that support level, which gives us the potential trade entry. We can see here that gives a 55, maybe a 60 pip stop loss there, a 60 pip stop loss, whereas on the daily charts, this would have been much closer to around about 80 pips. So this time we didn't actually save perhaps as much as we thought we were going to. We had a 60 pip stop rather than 80 pip stop loss, but of course as the trade moves to the upside, that will make all the difference with the reward to risk. If we look at the original stop loss, of course being underneath this level, and trail the stop loss to the lowest low of the last 3 bars, we can see this would be around where the trade would get stopped out. If we traded this on the daily chart with an 80 pip stop loss for a 57 pip return, it would have been an inverse reward to risk trade. However, jumping down to the smaller time frame, the 4-hourly chart, we now see that actually taking the trade with the 60 pip stop loss, it generated 80 pips of profit, which turned out to be a positive reward to risk trade. So we can see straight away that it's this dropping down the time frame, having to be in front of the charts for a little bit longer, understanding that you will miss some of these trades, but when you do get them, they give a very, very good reward to risk, and they shift some of your daily chart trades from potentially being inverse reward to risk to potentially being positive reward to risk. Of course, we've looked through several decent examples there now, whereby there's been reasons to take the trades. Sometimes price will change like this. There will be no level perhaps to trade from, and you will perhaps miss the trade. Other times, there'll be very, very strong levels seen here, and you'll get very strong moves off of those levels. In fact, if we actually zoom in and have a look at this most recent move off the level, we can see on the daily chart there was no real divergence at all there. There was no real daily signal, but it was a strong horizontal level. And the only real price action on the daily chart was an inside candle or an inside bar. There was nothing else particularly to give us the signal. Whereas jumping down to a 4-hourly chart, just highlight the area, look at the 4-hourly chart now, we'll be able to notice and zoom in and see that actually there were signals here. Price action wise, there was actually a bearish pin bar. We can see that by the long tail. There's no reversal bar formation here, but there is divergence. We can see with the stochastic, the lower high on the stochastic and the higher high on the price action. And when the stochastic actually flipped over, it was just after this bearish pin bar. It was this seller candle, this bearish candle here, that gave us a signal which triggered a very strong move to the downside. We've seen several different examples now of some of these good winning trades that have moved a long way. Let's now have a look at perhaps one that may have failed. We're going to look at this resistance becoming support, and we're going to focus on this cluster around here. Looking at it from a daily chart perspective, resistance becomes support in an upward trend, and sellers become buyers, and we actually have perhaps a bullish pin bar there if we zoom in a bit closer. Yeah, we have a bullish pin bar plus the reversal bar formation. So there's certainly a reason to want to enter that trade, and in fact the daily chart had a stop loss around about 40 pips. So certainly a very tight stop loss for a daily chart. There may in fact have been no reason to drill down, because the 40 pip stop loss on the daily chart is already a pretty good one. If we do drill down to this 4-hourly chart to have a look, we can see price was cycling down into the level. We can see here the shift from sellers into buyers. And unfortunately here, there's no real divergence as such. We have a lower low and a lower low. And again, we have ourselves a lower low and a lower low. The only real divergence there is a really, really long-term divergence. And that's kind of a bit too far to really take into account. Bearing in mind with divergences, we only really look at the last 3 peaks and the last 3 troughs. And on this one, we're going back 1, 2, 3, 4, 5. So there was no real divergence signal. There was the price action signal. And of course, price action rules above everything else. We can see here, looking at this one, that actually there was some movement to the upside. But had we trailed our stop loss on the daily charts, the best we could have hoped for would be around about a break-even trade. Bearing in mind we saw price move to the upside, and had we used our trailing stop to the lowest low of the last 3 days, it would have been somewhere around here, would have been stopped at. Daily chart wise, this would have resulted in around a break-even trade or a small loser. 4-hourly chart wise, would have entered with around about a 20 pip stop loss for around a 13 pip return. Nothing to speak of. It actually turned out to be a small winning trade, but nothing like what we saw on some of the other trades. We can see there that you going from one time frame down to the next has given us some really good trading opportunities. At the same time, you also need to make sure that you respect time frame correlation enough to begin with that you only go those one time frame apart. As you progress as a trader, then in time you can move on to looking 2 time frames apart. But keep things safe to begin with, keep them simple, and stick to just the one time frame apart to begin with.